Hello everyone, this is me again, nagbabalik, your educational vlogger. As always, I'm Ethel Arellano, and for today's content, we're going to discuss the subtopics of investment portfolio management. So which are, first is the types of financial investment vehicles model, and the second one or the last one will be the market efficiency theory. So for today's content, we will focus more on types of financial investment vehicles model, and then there will be part 2 which will be focused on the market efficiency theory. So stay tuned. First, let's talk about the financial investments meaning. It is a financial product like a cryptocurrency or a stock that is bought with the goal of making money. Anything that involves investment, of course, ang end goal ana is financial gain, which is making more money or making more income. Each investment has a specific risks, advantages, and disadvantages that will determine how and when investors buy or sell them. Of course, kung mag-invest naman lang ganita, i-weigh ginato which is heavier. Dapat gid ang advantages para dili masayang ang atong money nga giput up para sa isa ka investment, which will lead to depression kay nagka-cause na siya og anxiety attack sa imo kay nalugi. Nga ano, so much better na atay knowledge more about financial investments and sa mga financial investment vehicles. There are types of financial investments that we'll discuss on the next slide so that we will, as an investor, no, matabangan ta kung asa na to ibutang, asa na mga investments ta haom, comfortable mo invest. Here are the types of investments. First one is the commodities. Then the second one is the real estate, mutual funds, equity stocks, and bonds. First, we'll discuss the commodities. What is commodities in terms of investments? Dira na butang ang mga basic goods and services nga pwede na to siya investan to gain income also, to gain money. Real estate, for example, condo. Condo is a form of investment kay wala na season sa vacation. Pag ang tao ganahan mo travel, they tend to rent or kana temporary living so that kana ma-enjoy nila ang ilang staycation. We also have the mutual funds. Mutual funds nowadays na siya package with health insurance. It is more kanang clicking sa mga tao nga gusto mag-apply, di ba? Kay you are not just securing for your future kanang money, but also for your health. Now, let's talk about the capital asset pricing model. Also may relationship niya sa katong mga types of financial investment vehicle. Of course, capital asset pricing model, nag-talk man gud siya about the relationship between systematic risk and expected return for assets, particularly stocks. No, naana ni siya formula nga standard formula para mabalaan nato ato ang rate sa risk na kanang mag-invest sa asset, particularly stocks. Now, it is widely used throughout finance for pricing risky securities and generating expected return for assets given the risk of those assets and cost of capital. Karon man gud, when we talk about the stocks exchange, dili ta kabalo, wala ta dili man gud siya dili. Let's talk about the goal of kanang risking investment through CAPM, or the capital asset pricing model. So the goal of CAPM formula is to evaluate whether a stock is fairly valued when its risk and the time value of money are compared to its expected return. So for example, imagine an investor is contemplating a stock worth $100 per share today that pays a 3% annual dividend. So the stock has a beta compared to the market of 1.3. So kanang 1.3 ato na gamiton unya nga variable when we were going to substitute on the formula given sa CAPM next slide, which means it is riskier than a market portfolio. Also, assume that the risk-free rate is 3%. And this is the formula of CAPM, where ER sub I is the expected return of investment, the R sub F is the risk-free rate, the beta of the investment, B sub I, ER sub M minus R sub F is the market risk premium. So as you can see on the bigger picture, mas dali siya masabtan, no? Ang market risk premium, before na makuha, let's minus the market return minus the risk-free rate. So, katong before, ang iyang example, the expected return of the stock based on the CAPM formula is 9.5. So, diri ang imuhang expected return of investment will be the 9.5%. Then, we have the risk-free rate also nga 3% because assume that the risk-free, ay assume lang na to nga ang risk-free is 3%. As I've said earlier, no, nga nakoy gi-provide nga video so that you and I magdungan ta nga makasabot pag yun kung unsa gyud ang CAPM or the CAPM formula or the CAPM itself. So here it is.
The capital asset pricing model, often called CAPM for short, is an investment theory that shows the relationship between the expected return of an investment and market risk. To better understand CAPM, I think it will be easier if we look at an example and how it can be used. This is the formula for CAPM, and if you are of the math persuasion, then perhaps this formula makes a lot of sense. But for the rest of us, let's break it down to try to make it a bit simpler. So there are only 3 inputs that go into CAPM. First is the risk-free rate. We're going to use the 10-year Treasury note, and as of now, it's September of 2018, the 10-year Treasury note is about 3%. Next, we have beta. Beta looks at the relationship between our investment and the market. For our example, we will use a stock. So for us, beta looks at how the stock moves compared to how the stock market moves. The market, by definition, gets a beta of 1. So let's use Apple's stock so we can see an actual example. So Apple's beta is 0.99. Now this is mighty close to 1. So what does this tell us? Well, it tells us that Apple's stock acts very similar to the market. So if the market's up 1%, well then Apple's stock will be up almost 1%. More exactly, it should be up about 0.99%. Same is true on the downside. The market goes down, Apple's stock will be down just short of 1%. And just to see how this impacts things, let's throw a second stock in there. Right now, Facebook has a beta of 1.2. So if the market moves up or down 1%, Facebook will move up or down 1.2%. The closer the beta is to 1, the more the stock moves like the market does. The final input in our formula is the expected return of the stock market. Now, coming up with this number isn't always clear. Some research companies publish what they expect long-term market returns to be. You could also use a historical average. For our case, we're going to use the average of the past 10 years, which is about 9% per year. Okay, so now we have all of our inputs. Our risk-free rate is 3%. Beta for Apple is 0.99, and for Facebook it's 1.2, and then we have the expected market return of 9%. Okay, so let's plug these numbers in. So RF is the risk-free rate. So here we could plug in 3%. This symbol here, this is a Greek symbol for beta. For Apple, we can replace this beta with 0.99, and we can put Facebook's formula down here, and there we will put 1.2. Then in the parentheses, we have the expected market return minus the risk-free rate. They call this the market premium. For the expected market return, we're using 9%, and for the risk-free rate, it's the same as the 3% that we're using over here. Now, for those interested, the horizontal bar that's above the R right here and here, well, that bar indicates that this is an estimate. So now we know we're using an estimate of expected market return, and that will give us an estimate of the return of this asset. That's what the lowercase a stands for. And over here, M, that stands for the market. So when we calculate these, we end up with 8.9% for Apple and 10.2% for Facebook. Now don't forget, the only difference between Apple's formula and Facebook's formula is their individual beta. So how can this be used? Well, one way you can use CAPM is to use it in calculating the WACC of a company. WACC is short for weighted average cost of capital. And that WACC can be used as a discount factor to value a stock in something like discounted cash flow. Now, technically for WACC, you would use both the cost of debt and the cost of equity. CAPM can be used as the cost of equity. So for a quick illustration as to how it can be used, let's imagine that Apple and Facebook have no debt, which means that WACC for both of them is the same as CAPM. Let's see how that would play out. Let's imagine that we had an expected cash flow coming from Apple in 2 years. And let's imagine that it is going to be $1,000. Well, since cash is more valuable today than it is in, let's say, the 2 years, well, what we can do is use the results of our CAPM calculation as a discount factor. So if I'm going to get $1,000 in 2 years, well, for Apple, using our CAPM results of 8.94%, we can use that as a discount factor. And we can see that that $1,000 in 2 years is worth $842.61 today. For Facebook, if we were also expecting $1,000 in 2 years, that would be worth $823.43 today. So in theory, that's the present value of your future cash flow expectations. So what you want to do is pay less than that today. And if your expectations are correct, well, the bigger the gap between what you pay today and your calculated present value, the bigger your returns will be. Now, CAPM isn't the only way to calculate a discount rate or an expected rate of return. There's also something called the arbitrage pricing theory that's quite popular. There are also a few multi-factor models that work as well. So keep in mind that CAPM is one of a few choices, not the only choice. At some point in the future, I'll do similar style videos to this on the arbitrage pricing theory and multi-factor models. And if you haven't done so already, hit the subscribe button, and I appreciate you staying with the video all the way to the end. Thanks, and I'll see you in the next video.
Before I end the discussion, I just want to share this with you so that you and I ma-apply na to, the ways or the 5 ways to talk like an investor. First is to plan. According to this picture, make a financial roadmap with long and short-term goals. So, bugat or dugay ang long-term, but kung naata ay financial roadmap, straight atong plano, nindot sa pagka-strategize, it will be successful. Next is educate. Bisag unsa pa nang butanga kung kabaluta, open-minded ka for everything, gusto ka na mabalaan, this particular in investment vehicles, no, mas maganahan gid ka because ang security sa imong future mag-drive sa imo for kanang motivation ba nga mag-invest ka, not just for yourself, kay makatabang man apuhon sa imong family, loved ones, or friends, no. Next is I even also kanang sa imuhang puhon nga mag-create na ka sa imong little family. So next is diversify. Consider an appropriate mix of investment. Kung small scale lang nga investment, no, diri butang kagamay diri, and then at least naa kay plenty of source of income. Then assess, determine the level of risk you're comfortable with. Ayaw og risk og dako kung dili ka sure ano bitaw kay ang ato ang instinct is kanang stronger ba So at least kana comfortable lang ka, dili ka ma-worry too much. Lain na po kayo na sige na lang tag hunahuna just because of your investment. It's not healthy for your mental health, right? Next, or the last one is open. Open a brokerage account, or open a bank account, open a financial account. In that way, kaya na mo ma-store ay mong money, kana, so at least layo ang temptation to spend the money that you've earned, hard earned sa mga investment na mga butang. Sayang kung imo na din ipariwara at the end. So that's it.